Hello everyone, this is sort of week 4/5 of my coronavirus videos. I didn't do one last week, it was Easter. I actually felt like there wasn't a lot unfolding last week from sort of the virus front. I'm going to speak really quickly on the virus and more about some markets because markets is probably more what people are looking to me for at this point in time. So, I'll just start out with and I'm, coming from home, a bit of a different setting. It's the weekend, and I'm, in sort of weekend clothing. But start with the virus, and you can see this is a chart that the Financial Times has been putting out. If people aren't familiar with this is a logarithm chart, and so what that does is you can see here, it's not a perfect one, but as regular intervals, the number is doubling on this side. And what this is a chart is daily confirmed cases on a 7-day rolling average by number of days since 30 daily cases were first recorded. So basically, it's trying to give you a feel on how the virus is tracking and whether it is peaking and starting to come down or whether it is still growing. And so why a logarithmic chart is used is because it helps you better understand the actual trend, okay? And so if we're going from here, this is a really good example here. We've gone from 20,000 here to 35. This was a normal chart. It would be up there miles and everyone would freak out. I'm not saying we shouldn't freak out, but I'm just saying that this has a better understanding of why we actually use that, and that's why this is pretty popular and used. You can see Australia down there, New Zealand down here with exactly what's going. There's a number of countries that have trended out. You can see that China actually has, after coming trended down, has kind of popped up as they are trying to reopen the country, and that they are getting little outbreaks and that sort of stuff. So I suppose one quick thing on this is that Australia tends to have done extremely well. I wouldn't say that our feeling here or what we're experiencing here is uniform across what's happening through Europe and the US. And that's probably something to keep in mind. Interestingly, New Zealand has gone the hardest on lockdowns, and it looks amazing here. There's a very big scientific sort of debate happening in New Zealand. If you jump on that Precure site that I kind of mentioned sort of 2 or 3 weeks ago, they go through all their Plan B and what's happening and the economic effect and a number of things, which is I find really fascinating. For some very good minds who are well credentialed to talk about it. But nevertheless, if I stay back or get back on target, we're going, okay, what's happening on the US? And so I think we need to think about this virus and what the effect is on things. And so the first one, I go, okay, well, what's happening in Australia? And so this is business confidence in Australia. And you can see this is the GFC here. This is where we are here. So business conditions have deteriorated. So this is this black line over here. And business confidence is through the floor, and it is the lowest number on the Westpac business charts since they were first started, which goes back well over 20 years. This isn't here, but it is by far the furthest back. And so that tells us something, that business people are worried as hell, basically. Next sort of thing, this kind of jumps a little bit to the markets. Okay, so business is worried, extremely worried, and so if you deal with business, you will know. But economic indicators about what's happening is going through the floor, and the share market is going up really through the roof in the last couple of weeks. Probably the best part of 20% off its initial lows. And so I'm going to drill into that in a second. But, that is, I suppose, what I'm trying to start here is going, there's a divergence between the economic indicators, so what's happening with the economy, and the share market. And whilst that can be okay at times, if the share market's more forward-looking, I think they're not focusing on all of the issues at the moment. I may be wrong, but I feel like there is a bit there to go on the stock side, on the economic side as well. I feel like we're getting a little bit of a divergence there. Third thing, before I kind of go back to the big picture, this is a couple of days old, but I think it's quite insightful. 152 million workers in America, 22 million of them lost their jobs in the last 4 weeks. And so this, I think, was probably Morgan here was a little bit ahead of the times because, over the couple of days, the risk he's saying is a risk could be my life's already ruined and I need to salvage what's left. We're going back. So we're going back to work, we're going back into business, whatever it is. I saw a number of things over the weekend basically inciting just, if you're not eligible for the government handouts, get back to business and get cracking. you know, um, you know, you're responsible to yourself at the end of the day, and you just got to get back into it. And I feel like more than anywhere else, America, Australia seems pretty compliant with what's going on. Maybe we have better government funding. I'd suggest that is the case. But I've seen some numbers on what percentage of GDP America is spending, and they are spending a fair bit as well. So, and then there's a little bit of underemployment here, and I think this is probably a good thing here or to think about. White jobs have started to get laid off. More likely, some of those people haven't fired because they've never had to navigate the system before, and I think that would definitely be the case. Okay, so this is a bit of a crude thing, but I feel like it absolutely sums up exactly what's going on. So when this was put out, it's a meme. $17 million jobs lost. Potential next quarter 30% off in the GDP. So how far the economy falls, the economic input that the whole of the country is putting out. We've got an absolutely brutal earnings season looming when we're coming into that now, and we're looking at it. But I talked a couple of weeks ago that the government are throwing everything they possibly can at this. And so this is someone as an investor, taking a selfie, and they've taken a snapshot of the only thing that people are focusing on, which is federal action. And there's a bit of a narrative going around about don't fight the Fed, and the Fed are going into everything, quantitative easing, trying to buy up everything, and just basically saying that everything's going to be fine. And that's where you're getting these sort of divergences. That the share market's rallying on that, going, well, it's going to be okay, no worries. Whereas the economic indicators are jumping well out. And so that's probably the key thing, in that the share market has gone bananas, but the economic indicators have got significantly worse, and looks like they're going to get significantly worse. So, we could talk about how long it's going to take to come out and all that sort of stuff. This Nucleus Wealth actually had an extremely good, long form article, so you can jump onto their website to get, the main parts of it. But I snipped out a couple of things, and they're talking about a couple of things here with, credit. This is a credit cycle, so how much debt, really, corporate debt to GDP is in the American system, and it's high. Okay, that is an issue. Rolling over the debt could be a problem. That's really what unfolded in the GFC. If interest rates increase on that, it's going to be harder to roll over, all that sort of stuff. And then how far can share markets falling? They're not spectacularly cheap. They're sort of 2018 levels. This is a price earnings chart. Like, it's not amazing as a metrics, because things have changed, because interest rates are at crazy record lows. And so that kind of skews that PE ratio, but it does go, they're at 2018 levels. They're not drastically cheap. So I don't feel like it's, ram into the share market at the moment, but I feel like it is, continue regular investments and those sorts of things at the moment, because the share market could keep going or could peter out for a bit, but we never get back to, taking into account what's going on. So I think a regular sort of targeted approach makes sense at the moment. A couple of things probably also to keep in mind is that just because the market is going terrible doesn't mean there aren't opportunities. So in the GFC, this was all the capital raisings, and so companies go out and go, I need to shore up my balance sheet, I need to get more money. So they go to their shareholders and go, give us, raise some more money. And so this is 1 day and 1 week, believe it or not, about what the performance was if you had participated in Rio Tinto. So they did a raising. They raised $4.4 billion, so not a small raising. If you'd participated in that within 1 week, you would have had 104% return. It's truly ridiculous. Wesfarmers, so this talks about the discounts. The discount to the last trade was 57%. Discount to the last trade for Wesfarmers was 21%. And then within 1 week, a 27% return. And so that just goes through a number of corporate ratings there. And there's been some raisings already in Australia. It is happening. More and more are coming. For the same sort of thing, go Oil Search, Auckland Airport, Cochlear Flight Centre, T+1. So this is one day after you've purchased them. And you can see they're the sort of 15, 11, but there's some bigger examples of 22, 30, 38, 63, 2, 38, 62, 14. Every company is going to raise in the next period of time. You can just, the writing is on the wall, the playbook is there. People will be doing it. Your fund managers are going to take advantage of that. One last thing that's a worry for me is just household debt. This is household debt to income ratios. It has consistently gone up and up and up. Total household debt to disposable income is absolutely through the roof, and housing debt to disposable income is through the roof as well. Then these stats are a little bit off because they don't necessarily take into account they tend to work on individual incomes, and so as there has been a trend over this period of time for secondary income earners coming into the house. What you find now, and certainly my experience through working as a financial advisor, is that most people are relying on a big portion of two incomes to service the debt and those sorts of things as well. And that's just sort of debt ratios that are needed to service how much income is needed to service debt. So that is quite a few things, and I think sort of the key here is this one, as crude as it is. I did try and find a more I don't know, more appropriate meme, or less crude meme, I should say. I couldn't find anything. So I was looking for sort of half an hour. I couldn't find anything. I probably could have made my own up. But nevertheless, I do think it captures about where we are. So individual questions, that sort of stuff, flick me an email, give me a call. I'm happy to take those calls. I hope all is well, and I hope we continue on this path of getting on top of coronavirus and moving forward to resuming some sort of normality in life. I do feel like it won't just march back to normal, and that's another thing for my hesitation about share prices rallying so strongly. Thanks, bye.